record this. There we go. So welcome to the hot tax topics for the special year of 2020. And this is a year unlike any other. And Chris, do you want to tell them a little bit why this tax year is unlike any other?
Well, thanks, Jim, for having me today. With all this, the world events going on and all the stuff that Congress has done earlier this year and all the stuff they still may do before the end of the year. And, we've got people that are in business that have, doing okay, never missed a step or missed a beat. We got other people that are like in the middle and it's like hurt them some, and then others have been decimated. So it's been a real challenge because everybody has different needs right now. And there's so many different things going on that came out of Washington with that CARES Act that I think is going to be impactful. Besides that came around earlier on.
Mm-hmm. Yeah. So you know what? Before we get started, this is a disclaimer. So this is, I'm a lawyer. This is not legal advice. This is information. Chris is a CPA and a CFP. This is not tax information. So take this with a massive grain of salt. We're going to cover these topics, and these are the topics that were put out in the email to you. These are very important topics, but this is a subset, and this is designed to run about an hour. I don't know if we're going to go that long. But this is a subset of all of these. So there are 40 big tax planning strategies that are available this year. And I've highlighted some that we're going to kind of work in and out of. And we're kind of going to discuss these as we go through the materials. But it's really important that, that you guys understand on a high level that there's a lot that you can do, but it is really, really important that you look at your situation before the end of the year. So I know when I was a younger lawyer, I made the mistake of not doing any tax planning before the end of the year. And I think as business owners, as people who are taking minimum distributions out of retirement accounts, whatever it is, whether you're working or retired or you're W-2, whatever, it doesn't matter. If there's 1 year that you're going to do tax planning before the end of the year, absolutely hands down, it is 2020. In 25 years of legal practice, Chris, I've never seen a year like this. I think it's safe to say you've never seen a year like this. The stuff that's happened, the money that's been handed out, the tax breaks that have been handed out, we're going to hit this on a high level. And if you guys have questions, there is a chat feature. There's also a Q&A. So if you have a question, put it in there. We'll kind of answer these as we go along. This is really a pretty informal, an informal format here. And Chris, I know before we started talking, I highlighted a couple of things that I know you and I talk about with our clients a lot. Do you want to talk about opportunity zones?
Yeah, we can talk about those. Those are gaining traction. I wasn't sure when they first started in 2018 how they would do, but it seems to be a lot of interest in those things. And it's a way for somebody to, instead of doing a 1031 exchange to avoid the tax, you can move it into an opportunity zone. There's some challenges there as well, but a lot of people are interested in those things. And they're a good vehicle to maybe escape. Let's say if you have a whole bunch of rentals and you don't want to be a landlord anymore and you want to get out of that and move it into an opportunity zone where it's more managed and, that type of thing. There's ways to do that and not do a 1031 exchange. One of the things that's out there is the tax bill that Biden is put out there is, he wants to get rid of 1031 exchanges. So those may go away. Of course, it may be a while before that because Congress has to, deal with all that stuff. It's not just because he wants it, it's going to happen. But it's definitely on the table if he were to win in November that 1031 exchanges would go away.
So an opportunity zone, that's where you sell a piece of real estate or perhaps a business, right? And then you can put that money into, and that's like a geographic zone. So they're in cities, Los Angeles, Bay Area, all across the country. There are these opportunity zones. So if you sell a thing, a business, a piece of property, you can invest that money in an opportunity zone and defer and sometimes eliminate capital gains tax. So
yeah, well, it's just any large capital gain is a good opportunity to do an opportunity zone. What happens is that the gain doesn't go away, or the tax doesn't go away. It gets deferred for now 6 years. You have to pay the tax to the feds in 6 years in 2026. The state you got to pay today, so you don't get a break on the state. But what happens is when you move it into the opportunity zone, if you leave it there for over 10 years, any gain from that new asset, there's no tax on it if you were to sell it. So that's the benefit of that. And they're trying to, in the opportunity zones, it's interesting. You'd think it's in areas that are, kind of tougher areas to be in, economically, but it's not. It's a mix of some of that, but there's also some areas that are like, wow, how did that become an opportunity zone? So there's a lot of different options there.
Yeah, and I think this year, well, let's I'm going to start with our first poll here. Let's see here. Our first poll is, do you typically do tax planning prior to the end of a tax year? And so you can go ahead and answer yes or no. So we've got the poll here. We've got 25% of the people voting, 36%. We've got 60 coming up on 65%. And 73, 70, we're getting close. We'll give it another 5, 4, 3, 2, last straggler, 1. All right, we're going to end the poll and I'm going to share the results. And look, it's kind of like the Pareto principle, right? The 80-20 rule. 70% of people do tax planning prior to the end, 30% don't. For the people that typically don't do tax planning, I'm going to speak to you. This is, if there's ever a year to do it, absolutely hands down this year. So let's talk about Roth conversions. So I love this cartoon because he has this beautiful tree. He says, I only had to pay tax on the seed, right? I didn't have to pay tax on the whole tree and the fruit. The big headline for 2020, the big headline, no minimum distributions. So question is, are we going to talk about the opportunity zones later? You know what I'd like to do, Anita? That's a great question. We're going to be offering you guys, everyone who attends here, a 15-minute call with either someone in my firm or someone in Chris's firm. Whether it's us or not, we're not quite sure how our schedule is. But if you would like to talk about an opportunity zone, I think you should talk to Chris or talk to somebody in his firm. And Anita is a client of ours, Chris, a good longtime client. And that's somebody who I think could benefit from it. So
sure,
Roth,
yeah, I'd be happy to do it.
Yeah, Roth conversions. Let me kind of give, I think most of you probably know the difference between a Roth IRA and a non-Roth. But when you do an IRA or a 401k, you're putting in pre-tax dollars. So if I make $100,000 a year and I put in $10,000 into my 401k, I'm only taxed on $90,000. That $10,000 hasn't yet been taxed. And then when you retire and you reach a certain age, and now that age is 72, it's been bumped up from 70 and a half. So that's kind of cool. If you're born July 1, 1949 or later, that your minimum distribution is delayed till age 72. But with a traditional IRA, when you hit 72, you must take money out. 3 or 4% is what you're starting at, a little over 3.5%. You have to take money out. And many of my clients have rather large IRAs, and their minimum distributions might be $100,000 a year. They don't need the money, but they have to take it out. A Roth conversion is a process that you go through to say, I've got $1 million IRA, but what I'm going to do this year is I'm going to convert $50,000 of my IRA to a Roth, and next year 50,000, and next year 50,000. So after 20 years, right, doing simple math, you now have completely converted your Roth. The huge benefit for your heirs, when you die, your heirs still have to pay the tax on that money. But now they don't pay it all at once. They get to wait for 10 years. If all the stars are aligned and everything goes right, all that money comes out in 1 year, 10 years after you die. So that $1 million IRA becomes $2 million, and your kid who lives in California takes a $2 million distribution from an IRA. And the taxes probably then will be 75%, right? Right now, they're a little over 50. That's an IRA. That's how a Roth IRA works. 2 big benefits to a Roth IRA. Number 1, no minimum distribution during your lifetime. That is a huge game changer, right? For many, many people. No minimum distribution during your lifetime. Secondly, your kids do not pay tax on that money. Now, they have to take it out of the Roth at a certain point, but they don't pay tax. So this apple tree here, where the guy paid tax on the seed, really can make sense for people, but very important, you have to do the Roth conversion before the end of the year. You can't look at your taxes in 2020. You know, it's the calendar year 2021. You can't go back and say, oh, gee, I should have done that Roth conversion. And minimum distributions have been suspended for 2020. So you don't have to take that minimum distribution out. Chris, walk me through what type of analysis are you looking at with your clients when they say, hey, I'd like to do a Roth conversion?
Well, there's a few different things there. It's the tax rate that they're in. One of the opportunities that's going to be out there, I mean, when we think about back into February and March when the stock market dropped a lot, it would have been a good time for all of us to do that, not knowing what was going to happen, but nobody knows, you know, back then. But a lot of times the best time to do this stuff is when it is low, the market has dropped. But also what I've been looking at with clients is the ones that have been really hit the hardest with the COVID virus is that they might have losses on their business, and we can do the Roth conversion to offset the loss and really move it out without either any tax or minimal tax, and try to get it to that most of the Roth conversions in the lower brackets is what we try to do. When you start pushing it up into the higher brackets, meaning that you've got a lot of other income and then you add this to it, it starts to become, you know, tougher to do because you got to give, you know, the government, you know, 37 cents on the dollar and the state another 9 or 10 or 11%. You got to have another bucket to have that money to send to them to move this money over. And a lot of people do it. I have some that still do it at that rate, but most of the time with Roth conversions, it's done when you're at a lower rate or you've got a loss to offset and that type of thing. And I think we're going to have a lot of opportunities in 2020. I've already been talking to clients about potentially doing a Roth conversion versus doing a net operating loss carryback, which we can talk about later. But those are all things that are going to be opportunities for 2020 that we've got to do between now and December 31st.
Yeah, so the clock's ticking. This is not, and believe me, you do not want to wait till like, oh, I'll do it after Thanksgiving, after the holidays. We are so busy right now helping people take advantage of this stuff. And I'm sure, Chris, you're equally as, I know I've been talking to you a lot this year because Chris does my own personal taxes and corporate taxes. But I really would not wait on this. So question is, if you don't do a Roth conversion, will the IRA legacy trust at the time of death or the trust help? Absolutely. So you can leave your IRA or your Roth, both of them, to an IRA legacy trust. Now, normally, if you leave an IRA to a living trust, that's a bad idea. If you leave an IRA to a living trust, that living trust needs to be like 200 pages long. And I'm telling you, nobody wants a 200-page living trust. Forget about it, right? Nobody wants that. So we break it up into two separate trusts. It's very specific, very tailored to the Internal Revenue Code. But one of the powerful, you know, whether you do a Roth IRA or not, it is a plan for your IRA. So something you need to understand, if you have a 401k, you have creditor protection. When you roll your IRA, when you roll your 401k over to an IRA, you have about $1.2 million creditor protection, more or less in California. And then when you die and that IRA goes to your kids, there's no creditor protection, zero. There's no divorce protection. And I can't tell you how many times families, the mom and dad die and the kids, the future ex-son-in-law and the future ex-daughter-in-law, right? They come and they want to find out how much their spouse is inheriting, and they kind of cajole them into putting into a joint account, and then they file for divorce because they've been waiting for years for their, you know, in-laws to die. That does happen. So it's very important, if you're at all remotely concerned about asset protection for your heirs or divorce protection, one of the things I would recommend that you do is you give, you know, call me on the planning side about who inherits your IRA. In terms of the how to do whether you should consider a Roth conversion or not, that's in Chris's zone, right? And your financial advisor. So that's typically something that is a math analysis. It's a tax bracket analysis. And Chris looks at your overall situation and says, you know what, if you put it in this bucket, there's more wealth for your family. I mean, that's kind of on a very high level. So answered that. And then we have your property tax increase. You know, one of the things that's not very well understood, this is the letter to all county assessors that went out in 2019 from the deputy director of the property tax department in Sacramento. And what this says, this is a letter that directs the counties how much to increase property taxes under Prop 13 every year. So Prop 13, you guys will remember, that's the law, the constitutional amendment to the state of California's constitution that limits property taxation to basically 1% a year, plus some add-ons, some local add-ons. And then the increase is limited to 2% a year, but that's tied to the California Consumer Price Index. And so one of the things is it to increase your taxes is not tied to the California Consumer Price Index. But if your property goes down, like if you buy a property this year and next year it goes down, for those of you who have purchased commercial property, all right, offices, retail, even rental properties, the value of those properties has gone down. It's a fact. Now you may see nominal prices going up, but I'm telling you, I'm talking to mortgage brokers, and when I have a mortgage broker friend, she's buying a multifamily apartment building. They give her 0 credit for the rents, 0, because if you sign a declaration, you only need to pay 25% of your rent. So I think a case can be made that the value of your property has gone down this year, and that's one way under Prop 8 that you see here. If the value of your market value of your property has gone down, you can get a reduction in your taxes. So this would be more for people who've recently purchased property. If you've done a 1031 exchange, if you've held the property since the 70s, probably not going to help you because the property's gone way up still. But there's a softening going on in the commercial and multifamily market right now. Another thing is preserving Prop 13. Chris, I think this is really important. I know it's important to you and your clients. The Prop 13 I view that as a very valuable property right. And so you can pass on your Prop 13 taxes to your kids. And a lot of people don't know this. Now, there are 2 ballot initiatives that might change this if they pass, or will change it. But this is a very important property right, and you really do need to pay attention in your estate plan, because very common drafting, I don't want to say errors, but if you don't pay attention to it and don't put the right words in there, it can jeopardize your Prop 13. So you definitely want to check in with a savvy expert estate planning attorney. So, I had a Roth poll. I'm going to launch this poll. Do you currently have a Roth IRA or a Roth 401k? It'd be interesting to see how many people have a Roth. Wow, we have a lot of people on this webinar. And the votes are coming in. They're coming in. It's about 50-50. It's about 50-50. While the votes are coming in, let me tell you about one person's, this is a well-documented story. Peter Thiel, one of the founders of PayPal, in 2009, did a Roth conversion. He cobbled together whatever money he had in an IRA, $500,000. This is well documented. He bought Facebook. He bought 10% of Facebook at a $5 million valuation. He has about $3 billion in his Roth. $3 billion. He'll never pay income tax. Estate tax is a different question. Okay, so we're going to end the poll. We've got 80% of the people voting. Man, I hope this is not like the election. It's 49-51. So half of you have a Roth IRA and half don't. But you know what? I will say, for those of you who have done the Roth IRA, or if you've considered a Roth IRA, it can be a very powerful tool for your family. And so it looks like we've got a question here. Yes. So Linda says, hey, my internet's cutting in and out. Can I have a recording of the webinar? I am recording this webinar. We'll certainly make it available to you. And Kunal has a question. I'm actively trying to find a tax strategy CPA. Can you make any recommendations? Well, Kunal, you're looking at him. It's Chris Mann. So Chris Mann and I work together with many, many clients. So that is, we can certainly help you out. And to that end, we're going to be offering kind of a 15-minute, just a chat to see if we can add value. And then that we would have a second meeting after that. But whether it's with me or with Chris or somebody else at our firm, I really encourage you to take us up on that. And then we've got Socorro asks, Chris, I'm not sure what this is. Is a Roth conversion the same as a backdoor IRA?
The backdoor IRA is a way for higher income individuals to be able to do a Roth contribution each year. What happens is if you're up above like 190,000 of adjusted gross income, you can't technically put money in a Roth IRA. But what you do is you put it in a non-deductible a non-deductible IRA. Then the next day you have your financial advisor switch it over to a Roth, and then you're all set to go. So it's kind of a funny way to do it. I don't know why the government has allowed that loophole to be there. In my opinion, they should just let anyone put money in a Roth each year or get rid of this loophole. But that's the way you do it, is you take and you put it in a non-deductible IRA, and then the next day you switch it over to a Roth IRA, and then you're all set.
Great.
But that's different than a conversion, because a conversion is taking IRA money that you've had in there for years, perhaps, and rolling it over to a Roth IRA.
Yeah, that's what the slide, the Roth conversion slide, kind of assumes that you've already funded an IRA or 401k and you've rolled it over and you're doing a Roth conversion. Dennis asks, is the sale of collectibles exempt from capital gains this year?
No, not that I know of. It's still subject to tax.
Is there any limit on the amount for a 401k or IRA to a Roth IRA? I don't think so.
No, no limits.
Nope.
No limits.
Nope.
Yep.
No limits. Can drop money be converted into a Roth IRA value 300,000? DROP.
What was that now?
Drop, DROP.
Drop money. Is that still, as long as it's an IRA, you can put it into a Roth IRA.
Yeah, as long as it's an ERISA plan, right?
That's right, or an ERISA plan. Yeah, as long as it's in an IRA or ERISA plan, you can roll it to a Roth.
Yeah. All right, so let's see. Is there a limit on the non-deductible IRA? I don't think so. There's no limit on the non-deductible.
Yeah, there is. It's still the same limits as on a deductible IRA. You can't do unlimited. If you're just putting it in, yourself, there is the same limits, depending on if you're 50 or over, under 50 or over 50.
And then can't you take your basis out first on an IRA if you have basis in your IRA if it's a non-deductible?
Right, that's correct.
Right.
And same with the Roth. The Roth, you don't have that, but you basically you're dealing with a non-deductible IRA. You take your basis out first.
Great. Selling property in 2020, specifically in 2020, without paying capital gains tax. I saw Joe Biden's proposal and I looked at it and I thought, wow, this is going to affect a lot of people who've been thinking about a 1031 exchange. I know my parents moved from California to Texas to be closer to my aunt. They're living in Fort Worth. They did a 1031 exchange on some California properties out to Texas. And we'll talk about this, they have successfully extricated themselves from California's worldwide taxation structure if you're a California resident. But let's talk about selling property in 2020 without capital gains tax. Let's talk about the $250,000, $500,000 exclusion. Chris, you want to walk me through that?
Yeah, that applies if it's your primary residence, meaning that you've lived there as your primary residence. Both if you're single, then you get $250,000. The first $250,000 of capital gains is tax free. You don't have to pay any tax on it, federal or state. If you're married, it's $500,000. But both of you have to meet the 2 out of 5 year rule, meaning that you've lived in the house 2 out of the last 5 years that you've had the house. And so most of the time people can qualify for that, and that's a nice deal. That's been around since 1997, so it's been a long time that's been in place. That one's a good one, but it only is good for primary residences. So.
Yeah, and if you do a 1031 exchange, so primary residences, you can sell your home and exempt $250,000 or $500,000. $250,000 if you're a single filer, $500,000 joint filer. And what's interesting is if you're married and your residence is a separate property residence, you can still get the $500,000 exclusion if you're a joint filer. So that is a question for some of our clients get married later in life, blended family. And so they're like, well, it's my house and then I want to sell it and move. The other thing you can do is move your Prop 13 tax base within a county, in any county in California, and about 7 counties to go. If you go from like LA County to Orange County, you can take your tax base. But if you go to LA County to El Dorado County, you can't. If you go from LA County to Placer County, you can take your Prop 13 tax base. And that's a once in a lifetime thing. You can only do it once if you're 55 and over. So super powerful. So 1031 exchanges have something called an accommodator. So if I'm going to sell my property to Chris, I'm going to sell my $1 million apartment building and I'm going to do a 1031 exchange and I'm going to sell it to Chris, I have to involve the accommodator before the transaction really gets along too far. So what that means is there's a third party, and we're having an upcoming webinar from API, which is the #1 1031 exchange company in the world. We've got that coming up in January. And that money sits with the accommodator, right? Meaning it sits with this third party, and then you have a period of time to identify a property, and you have a period of time to close. So you have two stopwatches running. There's a 45-day window or 45-day stopwatch and a 6-month day stopwatch, meaning imagine you have two little stopwatches. You sell the property, both watches start. The 6-month one never clicks off. It just, if you don't close within 6 months, sorry, but you have 45 days to identify another property. So sometimes people will identify a property and then 10 or 15 days go by and then it falls out of escrow. Well, you better start finding another one pretty quick, right? Because you're going to run out of time, and people do run out of time. Jeffrey S. has a question. Is there a limit on the non-deductible IRA? Yes, there is. And what is it? I think the question is, what is it?
Well, if you're over 50, it's 7,000, and you're under 50, I believe it's 5,500. And that could be maybe 7,500 and 6,000 now for 2020, but it's right in that area. It's a little higher if you're over 50, but I think it's 7,000 if you're over 50 and 5,500 under.
And
under
Anita
50.
asks, do you have to be married a certain amount of time to be considered for the $500,000 tax exclusion? My understanding is if the year that you take the 121 exemption or exclusion is the year that you're filing jointly, that's what matters, right?
Yeah, and it matters if you lived in the house too, because both are supposed to live in for the 2 years.
Ah.
So that's the way it's supposed to work, is both are supposed to be in the house for the 2-year period of time, whether they're married or not. At the time, the whole 2 years is not relevant, but it's relevant about if they've lived in the house for the 2-year period out of the last 5.
And Betty has a question that comes up a lot with clients. She says, if I have a rental and I move in the rental and live in it for 2 years, can I then sell the rental and use my $250,000 or $500,000 exclusion?
Yes, yeah, you definitely, as long as you haven't used it in the last 2 years, you can. The only issue with rentals is you got to pay taxes on the depreciation you've taken in the past as a rental. So you still have to do that. But otherwise, you don't have to. You still get the 250 or the 500, but you got to recapture that depreciation you took.
Yeah, and it's an either or. It's binary. You're either going to use your 250, 500 exemption, or you're going to do a 1031. You can't do both, right?
That's correct.
So this is a problem that clients who are moving from the Bay Area, we have a fair amount of clients in when I say the Bay Area, for those of you in Southern California, I mean the San Francisco Bay Area, not the South Bay by Torrance, and people in West LA. A lot of times you might have paid $200,000-300,000 for your house and the thing's worth $3 million. Well, one problem is if you only have a $500,000 exclusion, you have a big capital gain. So what do? And that's where you come in. That's where you start looking at other tax strategies, the opportunity zones. You can look at, you can wait till somebody dies, right? Because if it's community property, you get an adjusted cost basis. So what that means is my parents have purchased rental properties. And if my dad dies and my mom survives, she can sell all those properties free of capital gains tax. She gets an adjusted basis, meaning if they paid $100,000 for the property and it goes up to $500,000, she can sell that property for $500,000 and not pay any tax. That is one thing Joe Biden's tax plan is attempting to roll back. And when I mention candidates for president and taxes, Chris and I are apolitical. And I want to reassure you guys, the United States does well, regardless of whether it's a Republican or a Democrat in office, just economically and factually. This is a great country. We're going to be fine. So I wouldn't worry too much about it. I know that politics is a hot topic, but historically, it frankly just really hasn't mattered. So not that it doesn't matter, but it's not that one is demonstrably better than another when you look at economic growth of the United States. So multifamily, commercial, industrial. The commercial and industrial, something you need to understand, this Prop 15 that's coming out, that's on the ballot, would reassess property, basically reassess pretty much all commercial and industrial property. It's kind of a weird law to read. We've been taking a look at it. We've done, for those of you who've been on previous webinars, we've done previous webinars on it. But a lot of my clients have properties and they say, you know what? I don't want to deal with it. I'm tired of dealing with the toilets. I'm tired of dealing with whatever. The property values have gone up. My rents are low. My tenants aren't paying. You know, Newsom's canceling rent and mortgages, or that's, you know, what people want to have happen. So many people sell the property and then they do a tax deferred exchange, and they do one of three things. They buy another piece of property. So you might buy a Walgreens in Texas, right? And Walgreens pays you $20,000 a month rent for 30 years or whatever it is. They take care of everything. They pay the taxes. They maintain the building, right? That is called a triple net lease, where you just rent them literally the dirt and they take care of everything else, right? A lot of clients like those. You can also go into what's called a DST, which is a Delaware statutory trust, which is kind of like a private REIT. So you can sell your property and you can put that into a portfolio of professionally managed properties. And that, for a lot of clients, that works for a lot of clients. They're getting a 4.5%, 5% return. And then there are these other strategies to reduce taxes if for some reason a 1031 won't work. So if you see Biden's proposal and you start panicking, like, oh my God, I need to sell this property, but I can't sell it until after the election. And if this law goes through, I'm going to be paying a bunch of taxes. Don't hit the panic button. Okay. There are a lot of other strategies out there that work and that can mitigate and delay and defer and avoid tax. So don't lose your mind over that.
Hey, Jim, one thing to think about with that, what you just said, is that you think about when Trump ran in 16, he had a whole bunch of tax things he wanted to get through. Well, he didn't get them through till 18 because it took that long for Congress to get things done. So even if he wins in November, it still has to be Congress dealing with everything. And who knows what the makeup of Congress will be after this election. And even in such, I can't see tax laws changing even before 2022, perhaps. It would be the next time you'd see it. I do think tax laws are going to change a lot more often than they used to. It used to be just minor changes. We hadn't had a tax law overhaul like this in 18 that we just had back to 1986. We've had, minor things happen year to year, things like that. But this was a big overhaul between 18 and 2018 and 1986. I think we're going to see more overhauls, quicker, because as the political winds change, you're going to see them use that as a way to, to run for office. So I think we're going to see a lot more changes a lot more often.
Yeah. And not to get too kind of dorky and academic, but there's something called modern monetary theory, which kind of smushes together the Federal Reserve and the taxing authorities. And so if taxation has always been about fiscal policy, which is the government needs to raise money. But now they're starting to look at taxation as an arm of monetary policy. So let's give people a bunch of money, and then a few people will make a lot of money, and then we'll have pretty heavy taxes and take that money back out of the economy to keep inflation down. So I think there's a shift in the way people are viewing taxation, which is a different way of viewing it than it was before. So Anita asks, in that case, the highest price increase, can one take exclusion and 1031 the rest if the property's gone up? I think that we answered no on that. So if your home's gone from 500,000 to 3 million, you can't say, well, I'll take 500 on my capital gains exclusion in 1031. It's one or the other. You got to choose. So does the 250, 500 exclusion mean that no taxes are paid based on that amount? Yes.
Right. That's correct. Yeah. So if you have a gain of under 500,000 and you're married, then you're not going to have any tax. A lot of times you don't even have to report the sale on your tax returns because the escrow companies don't give 1099s. They're not supposed to when there's when the gain's under $500,000 like that.
If you sell that Walgreens in Kentucky, are the taxes benefits the same? Yes. So
yes.
That's the triple net. Inherited rental property. Inherited rental property. Does the surviving spouse have to pay tax on depreciation recapture?
It starts over again. So that happens is you don't have to. So all that depreciation that was taken gets wiped clean. And now you start over again at the new value at the stepped up basis.
That's right. And so an anonymous attendee says if the surviving spouse sells the property, so even if they don't, then there's no capital gain. Corazon says, my husband died. I'm sorry to hear that, Corazon. And the house we own was adjusted from original price. If I die, will the house undergo another adjusted cost basis? The house is under a revocable living trust. Corazon, this is kind of a complicated answer. It will get an adjusted cost basis if it is included in your taxable estate when you die. So if you had an AB trust and your property went into the B as in bypass trust, or B as in buried trust, or below ground trust, then it will not. If it's in the A trust, it will. And this is why it depends on when your husband passed away. If your husband passed away before this law passed in the mid 90s, I've seen many clients, whose spouses passed away, 25 years ago. I've seen many trusts put the house into the B or the bypass trust. And last year in our firm, we helped about 50 surviving spouses terminate B trusts. You have to go to court to do that. But we helped them terminate the B trust and save the taxes. So Corazon, I would strongly urge you to answer that question. Just give us a call, and we've got the number up here. Give us a call, schedule a quick 15-minute call with one of the lawyers. Hopefully we'll be able to answer that for you, but we certainly want to help you out. Let's see here. Spoiler alert. I'm on my Mac. I go between PC and Mac. I don't even know what button to push. Okay. Surplus lines coverage. Here's another one. If you said, hey, I'm making a ton of money in my business in 2020, let's cover surplus lines when we talk about loss carryback. Cost segregation. Chris, do you want to talk about cost segregation?
Sure. Cost segregation is a way for us, especially with commercial property. When you buy like a big piece of commercial property, you can have a group come in, and most of its engineers come in and assess what you're really buying. Because we all look at it and say we're buying the walls and the ceiling and a roof and everything else and the structure and stuff. And the biggest part of this thing is that there's different classes of depreciation that you have to use for the different parts of the building. So when you're looking at a building and you're looking at the exterior walls and structure and the roof and everything else, the IRS is going to want us to depreciate that over 39 years. Well, that's a long time. And so people are like, well, what about the inside stuff? Like the carpeting, the cabinetry, a lot of times when you go into an office like ours, they put up these walls that are temporary in nature that can be knocked down with a couple hammers and some guys in an afternoon and reconfigure the office. So those can be considered to be allowed to be depreciated over much less time. And the key is to get it under this 20-year depreciation life, because when you get it under 20 years, which most of the other stuff is, like carpeting, cabinetry, doors, the inside walls, stuff like that, then if you get it under 20 years, when you do these improvements, or when you originally buy the building, you can take that part of the purchase or the improvements that you do after you purchase and depreciate it for the IRS 100% the first year. Yeah, the state of California still doesn't allow that. They have a whole other way of doing it, so it's much slower with the state, but it's really beneficial for the IRS. Is the depreciation is much faster, and this mostly applies to commercial property.
Yeah, so for our clients who have commercial properties, this can be a really powerful tool. So if you couple this with a Roth conversion, or you couple this with tax year 2020, we're going to talk about loss carryback. 2020, it might be the most powerful tax planning year in my career. Chris, I don't know if hopefully it is. Hopefully 2021's not worse. But,
well, we had some people in 2010 and 11 when the markets crashed, that had tough years, were able to roll money from a Roth to a Roth, and they're looking back on it and go, wow, it was one of the best things I ever did, because 10 years later, look what it's worth, and they're not going to pay any tax on it. So that was there too. But you're right, this will be a big opportunity to maybe convert IRA money to Roth in 2020 under the right situation. But I think a lot of times with these cost segregation deals is that it's best to hire a company to do it. Some people will try to wing it and say, oh, that's this much for this much for that. It's harder to justify if you get scrutinized by IRS when you just kind of winged it. Whereas if you go in and hire a firm, and believe it or not, there is firms that do this for a living. They go out and that's what they do. And they provide you with a real in-depth report backed up with engineering and things like that, which on the bigger deals, you definitely got to use them. It's worth the fee to pay them, because you're going to take a lot of that purchase or a lot of that remodel and take it from 39 years depreciation to maybe right away year one.
So here's a trick that we do for some of our clients who haven't yet done this. And this is why, if you have a spouse die, I've heard it, this is a lot of my widow clients, little old lady clients. They say, well, I was told not to do anything for a year. Don't do anything for a year. Okay, that means don't get remarried and don't sell your house and don't make any big decision. But you absolutely have to meet with your attorney and your financial advisor and your CPA before the year is up, because you can do cost segregation in the year that your spouse dies. And guess what? You get a new cost basis. You get an adjusted cost basis. So this is an extremely powerful tool. And especially in 2020, because when we talk about the loss carryback, you're going to see it's a multiplier effect. So Anonymous says, if I'm planning to sell my inherited farmland in Kansas by the end of 2020, what's the best tax advice to do with the $200,000? Talk to Chris, talk to someone at Chris's firm. We need to know what the basis is, because just because you inherit it at 200,000, I'm assuming, doesn't mean your basis is 200,000. Sometimes it's lower if it's coming out of an irrevocable trust. So you need to really pay attention to that. If a couple owns a duplex, husband dies, does wife's ownership in the trust eliminate the recapture of depreciation and restart the property value at the time of death? Is this what I understood? Yes. You need to let and so for people who do their own taxes, if you don't know the rules, you don't know to change your basis, right? So that's really important. This is why it's important when somebody dies, you absolutely need to see a CPA and your attorney. I mean, if you have property, if you have $20,000 in the bank in the mobile home, it probably doesn't matter. But I think for, people who are on, who've been invited to this, I think it does matter. So give us a call. If you want to talk about selling property without paying tax, there's Chris's number, 916-774-4208. And then our firm, Cunningham Legal's number is 866-988-3956. Set up a quick 15-minute call. We'll just have a chat and we'll see if there's anything we can help you with. Okay, next one. Friendlier laws for net operating losses in 2020. Okay, this is the big reason probably the biggest reason why we did this and why you're here today. So it's very important to understand that there has been a massive change in the rules. Okay. So why don't you explain what a net operating loss is, Chris, and what the 5-year carryback rules are now?
Yeah, net operating loss is when overall on your tax returns, you end up with a negative amount. So you end up with more losses than income most of the time from selling, something, or let's say the business has a loss. It's going to be mostly the business has a loss, or in these cases where we just talked about with this cost segregation stuff, we actually can go back to 2018 and 19 and put that in place, because they didn't have that. They left that out of the 2018 Act when they put it in place, but the CARES Act restored that for 18 and 19. I just had a case where we did this and we were able to take much faster depreciation in 18 and take the big loss from 18 all the way back to his 2013 year when he had a lot of tax, and he's going to get a big check back for that because of that whole thing. So what happens is when you have more losses than income, when the 18 Act came out, they said, we're not going to let you go back anymore. Well, you have to carry it forward. There's only one choice. Go forward. That's it. Offset against income for 2019, 20, whatever going forward. CARES Act came back in and said, we're going to allow losses to be carried back now up to 5 years for 18, 19, and 20, because they're looking at it as like, this is a way for companies that maybe have been hit really hard by the virus to be able to go back and get some cash flow back from the government by taking the loss from 20 and carrying it back to their 2015 year or 16 or 17 when they had better years and they were paying tax, and recover some of that tax, and be able to, basically it's just another form of, like a stimulus type of thing is what's going on there.
Yeah. So let me kind of put this into layman's terms. If you have a loss this year, you can file a document and get money back for the tax that you paid in prior years.
That's correct.
If you have a loss this year, and I'm telling you, if you have rental property, if you have commercial property, people may be in there, but that's called economic vacancy. If they're not paying their rent, it's economically vacant. And I'm telling you guys something. I think COVID's going to be around over the soonest, the end of 2021. Bill Gates came out and he says he doesn't think it's going to be over till 2022. I think tenants are going to have a lot of protections going forward. And I think you're kidding yourself if you think, oh, it's going to get better and people just go back. You know, if they're not paying your rent now, we have huge unemployment right now, and unemployment's running out, and you really need to pay attention to this. And it's unique to this year. It's next year's different set of rules, but this year you want to scoop up all the possible losses you can, pick up some of that money from prior years. Now, if you have a business like a gym, or if you have a nail salon, or you have rent out a bunch of hairstyling chairs, that sort of thing, you may have some losses that are way off the charts. I mean, really huge losses. And my heart goes out to you, because it's a terrible thing to have the government say, this industry, you can get a tattoo, but you can't get your nails done. I mean, that's just crazy, right? I mean, tattoo parlors are open, but you couldn't get your hair cut. I don't know. So if anyone here owns a tattoo parlor, don't send me a hate email. But
one of the things, Jim, to think about, with commercial property rentals, in order to get the loss be where you can actually take it and it's not considered passive to you, where you have to suspend it and carry it forward, is you got to be considered a real estate professional, meaning that you're spending more than 750 hours a year in real estate, doing real estate activities. So a lot of times people get tripped up. They go, I get a big loss from a commercial property. Yeah, great, but you're not active in it enough to where we can take it as a deduction this year and carry it back. We have to suspend it and carry it forward. So most of the time it's going to be either the real estate professionals are going to be able to do that with the rental properties, or it's going to be your business that's going to create the loss. And there's ways to do it. And that's why when you started off at the outset and said, you got to do the planning this year. I mean, we do planning with our guys every year. It doesn't matter whether we have COVID or not. But this year especially, there's so many other things going on. That's why we're starting in early. I mean, I always tell people that the most important part of our year is always really about Labor Day to the end of the year. Even, we do the tax season and that type of thing. That's just filling out paperwork. The Labor Day time to the end of the year is when we really are giving out the information and strategy and figuring out how to do things so that we don't have surprises and we're able to take advantage of everything that's out there for each client. Because if we do it after the first of the year, most of the stuff we can't do. And so that's a big area there. This NOL thing, this net operating loss deal, is going to be a big deal for a lot of people that have had trouble with their business. And,
our firm got PPP money. We got a disaster loan, and we had a really tough time for a few months. It was really a tough transition to be working from home, and a lot of people were affected. A lot of our employees were affected by COVID, not necessarily getting COVID, but just the whole, like, kids at home, and it's just a crazy time. But this is really powerful for businesses, especially if you're a business owner. Even if you're not a business owner, there's a lot of other goodies in here. Okay, Dennis asks, what is the cost of rolling a $500,000 IRA over to a Roth IRA? Taxes for that year. I mean, Chris, you can answer that question, but your $500,000 is added to your income.
Yeah, it just depends on what other things you have. So if you're in the top bracket already, which means 37% federal and let's say 11 or 12 for the state of California, you're giving them half.
Yeah.
But if let's say you had a big loss from something, a business at $300,000 loss, then it's going to be much less, because you get to take the $300,000 loss and net it with the $500,000 of income, and now you're paying much less tax. So it'd actually be maybe a good move. But the other deal is to look at the $300,000 losses. Can I take that back 5 years and get a lot of money back there? That's the analysis you have to do.
Right. And so this is why I think this is why the planning part is important. And this is why we're doing this is I'm seeing this and I'm talking to clients and I'm realizing, Chris, a lot of stuff. I know a lot of stuff. We're walking around with all this knowledge. Our clients don't, by and large, know any of this stuff. Right. And so the point of this is do not wait, and don't do it after Thanksgiving or think you can wait, because I don't think we're going to have enough time. I just think everyone's getting really busy. So Jay asks, is it a good time to sell your house this year before going into retirement and buy a new house for another 2 to 5 years to get more 250, 500 tax-free gain benefits? Maybe. We're going to talk about retirement, Jay, and whether you can stay in California or whether you want to. I don't know. Kunal asks, what's your favorite book or resource on asset protection and on tax strategy? I'd like to spend some time educating myself so I can ask the right questions. Kunal, shoot me an email. I'll give you a list of books. We can certainly help you out with that. So let me ask you a question. Is it better to carry back the net operating loss or to elect to use it to offset future income? What do you think, Chris? What would be some examples where it might be better to take it on a future?
Well, if you've got a big income in the last 5 years and you had a lot of tax you paid, I'd go back, because then you get the money today, because we don't know what we're going to happen going forward. You know, unless you know for sure that, oh, things are going to be back to normal or close to normal going forward, and I'd rather use it there, and it's going to be a better deal going forward versus going back. Going back, we get the money right now. And so a lot of people, I think, are going to go back.
Let's say I knew I was going to sell my business next year.
Yeah.
You would have to just look at the numbers and say, is it better to keep it going back or going forward? So again,
and we've had that happen. Yeah. What happens is you sell your business going forward, that's going to be capital gain income, which is only taxed at 20%, right? Whereas if, let's say you go back to 2015 and you got all this ordinary income tax at 39.6, because back then it was a higher tax bracket. So you take that big loss and go back to 15, you're going to get a bigger bang for your buck there than going forward.
That's an example of arbitraging the tax brackets, folks. Dennis asks, what is the rate between short-term capital gains versus long-term? So I want you to talk about the federal, Chris, but for the state of California, there is no difference. In fact, California does not even have capital gains tax. California,
no, it's just ordinary income.
Ordinary income. So what about the Fed?
Everything. Yeah, the Fed basically is, if you hold an asset under a year, it's going to be whatever your ordinary income tax rate is that year, you're going to pay that same rate for the capital gain. But you get to offset capital losses against the capital gain, even if it's short term. If it's long term, meaning held by more than 12 months, then it goes down to, there's different rates. You can even have a 0% rate, you can have a 10% rate, you can have a 15%, you can have a 20% rate. And so that most people are paying the 20% rate, I would figure, on this call, though.
Okay. What about net? Do you lose the net operating loss if you die?
If there's no one around left, then yes, you lose it. If there's a spouse still left, then that goes with them still until they pass on. But if you're the last to die and you have an NOL, it's gone.
If you have an SBA loan, by the way, the SBA is forgiving interest and principal payments. Those are not taxable this year, so the forgiveness is not taxable. Okay, this is kind of near and dear to my heart because I've spent a lot of time. I would show my wife these slides. She goes, "That's like you in the pool," because I've spent a lot of time in the pool this summer, right? I've been working from home, and I'm like, okay, work's over. I'm going to go lay in the pool. So I hope for those of you who have a pool, I hope many of you have been having a good time in your pool, but I will tell you that my parents decided to move to Texas from California to retire. My dad's a retired lawyer. They're in their late 70s, and they're doing fine, for those of you that know my dad or my mom. And they moved in part for taxes, but it was very hard for my dad to retire because he's a professional, and being a professional, being a lawyer was his identity. And I know there are a lot of people watching this. It might be you. You might be married to that person who just can't seem to let it go, right? So I think it took, for them, they moved for 3 reasons. Number one, it was a clean break. My dad could close his law practice and move on to the next chapter in his life. They also wanted to be closer to my aunt. So my mom has a younger sister, and my mom's mom died when my mom was 11, and my sister was 5. She died of breast cancer in the 50s. And they had always lived apart since becoming adults. And so they just wanted to be closer to each other. I'm an only child. I have issues with all of that. But the reason I'm going through this is the last reason they moved was taxes, because they actually pay less tax living out of California. And unfortunately, California has the highest income tax. It has the highest sales tax. We have low property taxes or lower property taxes. There's no inheritance tax, no wealth tax. So taxes are one reason people move out. But Chris, why don't you talk about the analysis you go through with clients when they're going to, to answer the question, can you afford to live in California or not? And then also talk about Hawaii.
Yeah, I think that the thing I look at with all that stuff is more of lifestyle too, because, it is, I mean, California has such a great climate. So a lot of people stay here for that. And sometimes I think people move and then the tax savings isn't really that much. Like I have a client that's a manufacturing client and they get all these credits for the state. And they were talking about moving to Texas. And I said, well, you already are not paying California tax because of all these credits anyway. So you're not really having to worry about leaving for that. And he was like, oh yeah, I forgot about that. And so not everyone has to pay a ton of California tax. We've got clients that do R&D credits that their tax bill comes way down because of the research and development they do in their business. So it does bring the bill down. But most people are paying very high income tax. I'm seeing a lot of people move to Nevada. That's a popular place because it's easy still to jump back into California and visit family and friends. And as long as you do things right and set up all your things necessary in Nevada and you live there, then there's really not much California can do about that situation. And that's happening on a regular basis now. The other place that people don't realize is actually a retirement haven for retirees is Hawaii. And people go, Hawaii, well, they have a high tax too. And they do. And it's very expensive to live over there. But if you have a pension and you move over there, that pension is tax-free to Hawaii. Hawaii does not have a tax on pensions. And a lot of people don't know that. And so a lot of people that have moved there, they don't, when they get over there, they're pleasantly surprised that, because we have an office over there on Kauai. And so they're pleasantly surprised when they find out that they don't have to pay tax on their pension income over there, which is kind of a nice deal. And a lot of people don't realize that.
Yeah, it is. I mean, who doesn't love Hawaii? I haven't talked to a single person who's like, Hawaii, you can have it. It's a gorgeous place to retire to. They have really good healthcare there. Just great weather. So some other ideas, do you sell your home and do you move? Because, California real estate is typically, for many clients, it's one of their single biggest assets. One thing you can do is add an ADU, an accessory dwelling unit, and rent it out. And I was on the call with two clients who are business partners, and that is their business. They buy real estate and they add an ADU, an accessory dwelling unit, like a 2-bedroom, 2-bath, 1,200 square foot house with a 2-car garage and a deck and a pool. Sounds pretty nice in LA. And that's a way where you can get a return on money. You can also sell your home and rent. And for a lot of people, they go, I don't want to do that. But there are a lot of rental communities, multifamily communities, where you can live like 55 and over and pay pretty low rent, and you're not going to get booted out. I mean, that's the bottom line. If you pay your rent, you're not going to, it's a place for you to live. Living with family members. I know some people love that. Other people, they're like, that's a no-go, not going to happen. Reverse mortgage. What's a reverse mortgage? That's where you get a mortgage, and instead of you making a payment, you don't make a payment on interest or principal. That just sort of racks up and accrues while you're alive. You still have to pay the taxes and the maintenance. My in-laws did a reverse mortgage for a period of about 3 or 4 years. They bought their property it was 5 years. They bought their property in 2012 and sold in 2017 and went to assisted living. They made a lot of money net of the increase in the mortgage on the reverse mortgage. So if you play it right, it may allow you to remain in California, at least for a while. Co-housing. Chris, are you familiar with co-housing? One of my clients is one of the biggest co-housing architects, and it's where you get like a group of 30 people together and you build a community. Kind of cool. It's kind of a Nevada City, Grass Valley thing.
Okay, I like tiny houses.
Yeah, they're kind of like condos, and you get together and you cook dinner once a month. And then the other thing you need to think about is if you do move to a state other than California, that is a separate property state. So California, remember we talked about that adjusted cost basis. That only applies to community property. If you move to a state that's a separate property state, somebody mentioned Kansas. I believe Kansas is a separate property state. I don't have these listed in my brain, but I know that's not on the list of the community property states. That may impact the capital gains taxes you pay on your investments in the future. So something important. Now we have a lot of questions that came up. How do you establish the basis for collectibles that you inherit rather than purchase. Dennis, you get a valuation, and that's typically attached to the 706. And then if I move to Hawaii, but my rentals remain in California, do I still have to pay California taxes on the California rents?
Yes.
Yes.
Yeah. It's hard to get out of this place once you're here.
I'm 75 and don't plan on using my 401k for at least the next 5 years. Shall I transfer to a Roth IRA? Stan, are you still working? Yes or no? You don't have a minimum distribution if you're still working. Some people are still working at 75, but that's a question for Chris. And again, he's not still working. So that's something where you want to check in with Chris because he can sort you out on that.
I think it just depends on the tax rate it would be. That's what it would make all the difference there, is what tax rate it would be.
Joseph asks, if your IRA, Hawaii, if your IRA is your primary income source, is it taxed?
An IRA is taxed in Hawaii. It's pensions that are not taxed. But there's ways that if you had money in a pension, retired, and then rolled it to an IRA, they'll still let you exclude that. So you have to be careful, because if you started an IRA and just kept putting in your 6,000s a year and all that stuff, then that money doesn't get excluded from Hawaii income tax. But if you put money into your 401k at work, and then when you retired, you moved it to an IRA, you're allowed to exclude that portion of from tax over there. So you have to be careful and ask that extra question when somebody has that situation.
Yeah, given the question, it says if your IRA is your primary income source, so I'm assuming it's pretty large, probably some type of rollover from
probably came from a rollover, right.
Kunal asks, what are your thoughts about renting your California home and move to a more tax-friendly state such as Nevada? My parents sold some of their California real estate and moved it to Texas because the rents that you receive based on the value of the property are higher. California, as a general rule, rental property in California, you get a smaller return on your rents. If you go out of state, you typically get a bigger, so, $1 million property might pay you $40,000 a year in California. It could pay you $80,000 a year for $1 million property outside of the California. So so what about, and I think we're almost done. We're at an hour. So,
hey, Jim, have you seen a lot of the situations where people in California with all the wildfires are getting increases in their insurance costs, like the homeowners? That's another thing to think about with California too.
Yeah. And so what they do is, whether you're actually in a fire zone or not, you still end up with the high. I know I was living in an area on the western slope of the Sierras that basically was not a fire danger, but our insurance premium was huge. So
I know some people in Tahoe, their policy's gone up like 5-6 times.
Oh yeah,
it's nothing they can do about it, and they never had no fire or anything like that. It's just that they couldn't get insurance from their carrier, so they had to go to the exchange.
Yeah, and even if you clear your brush out 200 feet, 100 is recommended, 200 is even better. They don't give you a break, which is crazy.
Yeah.
So how do you become a non-resident? So if I want to save taxes, let's say, Chris, I'm so tired of paying taxes to California. I'm one of those people that I'm just kind of over it. It seems like I pay more in California state income tax than federal tax. How hard is it to get to extricate yourself from California?
No, it's not that difficult. What you've got to do is I always tell people, make sure your voting is done in the other state now. Excuse me. Your voting is done in the other state. You register your cars in the other state, get your license there, mail. And, but other things California would look at is utility usage. If you got a house in California still and a house in Nevada, they would want to look at maybe where the utilities are being used in various places to determine what's going on. And also facts and circumstances. If you got kids still in school, it's going to be hard to show Nevada residency when you got a kid down in, one of the high schools down in Sacramento or something like that. So you've got to be, really be out of the state and be in a situation where you've done all these other things. Bank account is good to be out of the bank up in Nevada too. Excuse me. And so those are the things those are the biggies: voting, banking, utilities, and vehicles.
So Socorro asks, did I understand correctly? If you move to Hawaii, and roll over your 401k to an IRA, you don't pay taxes on it, state taxes.
No, you'll actually be able to exclude a good sized portion of that from income tax in Hawaii. Yes.
So is it better if you're going to do a Roth conversion? Is it better to move to Hawaii for a year and not be a California resident and do your conversion and move back?
Yeah, that's an interesting one. I mean, that's actually, something that you could probably pull off.
It pays for your year in Hawaii, right? A tax plan. Okay.
Yeah.
There's a no inheritance or death tax in California, but there is in other states. And something you have to pay attention to is like, yeah, I'm going to move to this state. Great. I'm going to move to Oregon. I don't have to pump my gas. There's no income. There's no sales tax. But guess what? There's a 16% estate tax over $1 million. And that's a big deal for a lot of people. So, and they count all your property wherever it's situated. And then they kind of lump on that last. So even if you're not a resident of Oregon, if you have a house in Oregon, you're subject to their inheritance taxes. If we have a second home that has doubled in value and we don't really need it anymore, would it be wise to turn it into a rental and then do a 1031 exchange to another property, trying to figure out how to get another property without paying capital gains? I would say you would have to look at your gain if it's more than 250 or 500. If you're a single or a joint filer, I would look at that. But if your gain is beyond the 250 or 500, again, talk to me, talk to Chris on that.
Well,
one.
if it's a second home, they won't get the 250 or 500 because it's not primary. But in the IRS kind of frowns on second homes being used for 1031s. They're done. But they're not something that the IRS technically come back and say, well, that's not what we intended there. But I've seen them done many times. But I've also seen what they're suggesting is turn it into a rental first and then do the exchange, and then you can make that whole workout where you don't have to pay tax and it's deferred into the new property.
Yeah, and something to understand is taxation is not static. It is changing all the time. Okay, so not only the laws change, but then cases come out, and the positions of the state and federal government do change over time. All right, so if you want to leave California, just give us a chat. So very important, I think. If tax planning this year needs to happen before the end of the year 2020. You can call Chris's office at 916-774-4208 or our office, the law firm, at 866-988-3956. If you have not looked at your living trust in the last 3 years, I highly recommend that you do. If you already have a lawyer that does your estate stuff, go back to that lawyer. If you don't have somebody or you don't like that person, then we're happy to talk to you. But I'll just open it up. Any remaining questions? I know we're slightly over an hour, but it seems like we still have a lot of people on here. And I'm going to just put out one, and we have a raised hand. Bruce, maybe if you can put it in the Q&A, we can answer the question. I'm going to ask you guys a question. Was this webinar informative? Yes or no? It's okay to say no if you're like, I've heard all this stuff before. But we like yes. Wow, we got a lot of people answering. Holy smokes. 3, 2, 1. Okay, 1% said no. I think 99% is an A+. Okay, one more.
They couldn't see me all the time.
One more. Do you presently prefer to meet in person or by Zoom or by phone? And you can answer one of the 4. So Jeffrey asked a question, if I convert my residence to a rental, is there a minimum amount of time it must be rented before I can 1031 it?
Yeah, that's a good question. There's really nothing out there in the code and regs that says definitively how long you're supposed to do it. I usually tell people do it for a year. 2 would be probably even better, but at least a year, do it that way. That way it shows the intent is to rent the thing. So that's what I would say. But there's nothing out there that says you can't do it after 6 months because, our lives change a lot and things happen. And so if something comes up that makes you have to do this thing, then I don't think the IRS really can fight that, realistically, if you have a life event that happens or something like that. And that's why I think they purposely left it out, not having a definitive number. I think it's more intent. And, a year does show intent, in my opinion.
Yeah, and it's one of these things where you would be surprised. You would think that the law would be clear, black and white, yes or no. That's just not the way our legal system works.
No.
I mean, they do it in Europe. They'll be like this date, and if you miss it, sorry. That's culturally not legal. Our legal culture is not that. What I typically recommend clients do is it is best to have it on a tax return that's already been filed, where it's a rental. That's the best, because now you have a track record. If you rent it out for a month and then try and do a 1031, you might be viewed as gaming the system. On the previous slide, what did the numbers mean on the different states? That meant where people are going from California. Kind of interesting. Anita asks, I would like to learn more about opportunity zones. Any suggestions? Chris?
I can get you in touch with my office. We have a guy in our office that is basically been specializing in this area, and I can have you talk to them. So just call the office and we'll get it set up to get you in touch with them so you can go over that.
And Jennifer asks, hi, Jennifer. I know you're in Texas. I've heard that California is talking about taxing residents after they move out. Is that something that could really happen? The answer is yes. Do you want to walk through, if you do a 1031 and then sell the property later out of state, what you're supposed to do?
Yeah, there's a form that California wants now from all of us. If you sell a property and you leave the state, they want to keep an eye on you. And when you sell that other property in the other state, they want their share back that they didn't get on the first go around because you 1031 thing. So there's a form, I believe it's a 3840, that you have to file now every year with them. And if you don't file with them, you're going to get a nice little letter from them saying that, hey, you didn't give us this form, what's going on, type of thing. And so they're trying to keep trying to, like, there's a lot of stuff out there where they're trying to even tax people for 10 years or something that's out there. And there also is a bill out there that hasn't passed, and I don't know if Newsom's going to go for it, is it wants to raise the top rate from 13.3 to 16.8, which would be, and
I'm glad you mentioned that, because I think what people don't, they say, well, if you make more than 10 million a year, of course you should pay a higher rate. And you can debate that. Here's the problem. What I mentioned, California does not have a separate capital gains tax. So if you sell a business, you're subject to that huge tax because it's all treated as income. And that really, if you're an entrepreneur, you think, well, should I go to California or should I go to another state? And that actually does play into the decision where people go. So what's the timing for the 15-minute call, Jay? And he also asked, do we have to schedule the 15-minute? Yeah, we do scheduled calls because it just lets us be available. Otherwise, it drives us nuts. But generally, in 15 minutes, we can have a chat, see if we can add value. Sometimes it's a 2-minute call.
It's best to set them up.
Yeah.
One of the things, Jim, let me just add in real quick with this whole California thing. The thing that's really going to be a big issue coming up in 2020 and going forward with everybody working from home nowadays, and I'm getting a little bit of this now already, is let's say you were working in Silicon Valley for Google, and now you moved to Nevada because you can work from anywhere. Mm-hmm. Do you have to pay California tax anymore? I mean, it doesn't seem like you should, because you're working out of your living room in Nevada now. And that's going to be a big issue that California's going to try to, I'm sure they're going to try to not just say, oh yeah, go away, we'll let you go, don't worry about it. But it's so new that nothing's really happened yet, but I can see that coming down the pike soon on some of these guys that are making 6 and 7 figures, leaving the state, but still working for the company in Silicon Valley.
Yeah, I mean, who knows what's going to happen on that? I mean, under current law, they wouldn't be paying California income tax, would they?
Right, they shouldn't be. No, you're right.
Byron says, I have a second home in Boise that I plan to retire to in 3 to 4 years. Do we need to live there for 2 years thereafter to qualify for the $500,000 exemption?
Yes.
Yes. Anita asks, my accountant calls that the clawback. Yeah, the clawback. Okay, on opportunity zones, I'm meeting with Jeff, who's one of the attorneys in our firm, have appointment already for some updates. Can he help, or do I still call Chris? On the opportunity zones, Anita, I'll check in with Jeff, but you're free to call Chris. But you might want to talk to Jeff about that first. And Amber or Nicole, if you can remind me to chat about Jeff with that, we'll take care of that. Mark asks, can Chris elaborate on if you keep a home in California, one has an intent to return? What does intent to return mean?
I don't know if it matters about that. I mean, if you keep a home in California, you rent it out, you still got to file a non-resident California return. If you keep it as a second home, you don't have to do any of that.
Yeah. Let me see here. Oops. Okay, I hit the wrong button, of course. Oh, I'm not a technical person. Are we screwed? We're not screen sharing anymore. Okay. So now you get to see our big heads. All right. John asked, just to confirm, if I'm taking RMDs and my AGI exceeds Roth qualification limits. So if I'm taking RMD and my AGI exceeds Roth qualification limit, can I still do an IRA Roth conversion?
Yes.
Yes.
Yeah, there's no real limit on those.
And Kenneth asks, what about selling your property to a charitable remainder trust? If you're going to do a charitable remainder trust with the property, you need to set the trust up before you make the deal to sell it and put the property in there, and then the trust sells it. So, but you need to talk, that would be one where you'd want to talk to me before you go ahead and do that. And Ken also says, what's your feeling about donating, selling a home to a charitable remainder trust and receiving income for life, as well as receiving a tax deduction? I think it's great. I think that's an alternative for a lot of people. It's just really not something there's a lot of stuff we could talk about here. And it was kind of on that first slide of all the 40 different things that you could do. But again, this is just a very small sliver of all the things you can do. But, and I really want to thank you guys for sticking it out here for an hour and 15. Chris, thank you so much for doing this with me. I know this has been so valuable to so many people. I've gotten so many messages in here. Thank you guys so much. And
Well, you're welcome. Thanks for having me. Thanks everyone for having us.
all right. Have a great day. And
Take care, you guys.
You'll be getting a follow-up email with instructions on what number to call if you want to talk with somebody on the CPA side or the attorney side.
Yeah, it'd be great to talk to anyone that has any questions. Happy to do it.
Great. All right, guys. See ya.
Take care, you guys.